For decades now, many African governments have relied on loans issued in overseas markets to support their development needs. But there's a new trend of late toward domestic debt, which is showing promise in a number of ways.
At the moment, we're seeing a lot of interest from foreign investors who want to come and invest more in local currency denominated African government debt. So this comes with pros and cons. So, of course, you have to manage it carefully. My name is Amadou Sy, and I'm an assistant director in the IMF's African department.
Amadou Sy is also the co-author, along with Athene Laws, of The New Face of African Debt, published in the March edition of Finance and Development magazine. So your piece in Finance and Development is all about this shift from foreign or external debt to domestic debt. So maybe I should start by asking you what the difference is between those two types of debt and how they're typically issued.
Yeah, sure. So at the IMF, the key word is residency. So when, say, a government in Africa issues debt to non-residents, that's classified as external debt, even if this debt is in local currency. So what matters really is the residency concept. And conversely, when the debt is issued to residents, it's classified as domestic debt.
But when you say issued, how does that work?
Yes, so you could borrow from banks, or we could issue to many investors in the bond market. In that case, we would issue an IOU, which is a bond that would be then sold either to residents or to non-residents. So if it is sold to residents, that would be domestic bonds. Typically for African countries, it's a local currency domestic bond. But when these African countries issue to non-residents, typically it's in foreign currency, US dollars or euros, and that's in this market that is called the Eurobond market.
I see. So why is this happening? The shift that you describe in your article, like what is prompting this move away from external debt?
Yes, so in the old days, African countries used to have to borrow mostly in concessional terms from either multilateral agencies like the World Bank or from other countries. And you may remember this Paris Club, which we used to have France and UK and US and so on. These donor countries, either they would give grants or they would give loans to these African countries.
We should say that the Paris Club includes just about every advanced economy, but does not include China.
Exactly. So that's also part of the shift in the composition of debt for African countries. So what happened at some point, these bilateral donors, these countries had this initiative, the HIPC initiative, where basically they help reduce the debt stock of these African countries. And then the share of bilateral debt, which was very, very high in the 80s and 90s, before 2000, dropped significantly. At the same time, African countries started growing and then having also less eligibility to concessional loans, which are these very, very cheap loans. That's right. And then they borrowed in the Eurobond market. They went and borrowed in dollars, mostly in these international markets. And the Eurobond market was increasingly a source of debt for African countries. At the same time, they also started issuing more to their in their own markets, to their own residents. And so that's a little bit, so the bilateral share of total debt went down. The Eurobond share increased from nothing. Really, in the old days, it was maybe South Africa and Seychelles that were the only countries that could issue. And then the domestic share also increased.
So, I mean, you mentioned these concessional loans. I mean, obviously, the rates on concessional loans were very low.
Yes.
So domestic borrowing is typically more expensive, right? I mean, so what is the business case for this shift toward borrowing or, trying to keep things closer to home?
Yes. So one is that when you borrow locally, typically you borrow in your own currency.
Right.
So then you're really, really less exposed to currency risk. And for African countries, when they borrow in dollars, they have to find the dollars to pay back their debt. And it's risky, it's not easy. Whereas when you borrow in your own currency, it's much more manageable to repay. And then also you're issuing this debt using your local law rather than New York law or London law when you issue a euro bond. So it really makes things easier for African countries to issue domestic debt. Actually, if you look at the biggest economies in the world, the US, the Japan, the European countries, they issue in their own currency. The big difference is that, for example, for the US, you have foreigners buying the dollar debt of the US. For African countries, they're not there yet, but so these are the two, I think, main points: reducing your currency risk and being able really to pay your debt from the revenues, from your fiscal revenues that you would raise locally, rather than having to export and take a part of your export receipt to pay back your dollar debt, let's say. Yes, but then. The other challenge, though, is that typically as you're developing your domestic debt market, you would issue in shorter terms than what you could have if you were issuing bilateral debt or concessional debt, for example, from the World Bank, which can go 30 years or more. So that's one. And then when you issue in short term, you expose yourself to rollover risk because, let's say, if it is 6 months or a 1 year debt, after 1 year, you have to borrow again. And then there's a risk that your investors might say, well, we want a higher interest rate or we will not lend you as much as you want. Then there's also the cost too. These concessional loans, for example, are definitely cheaper than issuing locally.
Okay, so and you just touched upon this, the cost of borrowing, and we're hearing a lot from your colleagues here at the fund about the high servicing costs across the board and even in advanced economies. What does the domestic debt servicing cost in sub-Saharan Africa look like?
No, that's a good question. We've looked at the total servicing debt, and it's about usually 1/7 of your revenues are used to service your debt, your total debt. And this crowds out your development spending. These countries, African countries, need to spend on health, education, infrastructure, and so on. So right now, the cost of debt, so if you look at the stock of debt for African countries, for the median country, it has stabilized, but the cost of debt is still high and it crowds out development spending. But, I mean, there's a key issue here. When you develop your debt market, is it because it's a firefighting strategy where suddenly, let's say in 2023, no African country could issue a euro bond. Wow. So they were completely shut out of the market. So then you go back and you say, okay, I will have to develop my domestic debt market. But is it firefighting? Is it just a reaction to the fact that you could not get any borrowing externally from the Eurobond market? Or is it part of a deliberate strategy to say, look, I need to develop my domestic market. I need to broaden the investor base. I need to find more investors locally. The pension funds and the insurance companies have a lot of money in Africa, but most of the time it's in real estate. Right. So they're not buying government bonds and so on as much as they could, except some countries like South Africa and so on. So are you developing your investor base? And very importantly, because we need the engine of the private sector in Africa, are you helping your private sector also borrow locally, because if you establish a long, very liquid, very well established yield curve, right? So your borrowing costs at different maturities, it can help establish a benchmark for your private sector to also borrow locally, right? And help them get the financing they need and help kickstart this private sector engine to develop your country.
And I was just going to ask you that. I mean, how much buy-in have African countries got from their own domestic private sectors? And how much of a role will they play, this private sector play, in making this trend stick?
Yeah, no, this is a key question. For most African countries, very few private companies can issue externally. Of course, South Africa is an exception. Sometimes you see some Nigerian banks that are able to do it and so on. But really, most of the financing in Africa for the private sector comes from the banking sector in general. So the idea is really to have basically a complement to the banking sector. Because typically, even in the US, banks would go up to a certain maturity. And if you really want to borrow long term, you go to the bond market. Right, but that takes an ecosystem with, on one hand, those institutions that have long-term savings. That's why the pension funds, the insurance companies, and then those firms that are solid enough and have needs for long-term money and are solid enough to pay it back. Because we also have to protect the money of the pensioners, right? So it's starting. You have even some bonds that are listed for the blue chips in those African countries. But we really need more. We need a private sector that gets financing, and not only the short term, but also the long term. We need to also not rely too much on just the banking sector. We need to have a whole ecosystem. It takes time to build, but it's feasible and it should be done.
Does this encourage investors from outside to invest more in the country?
Yes, definitely. At the moment, we're seeing a lot of interest from foreign investors who want to come and invest more in local currency denominated African government debt. So this comes with pros and cons. So, of course, one advantage is you bringing in these investors. It's as you trying to broaden your investors base. It's not just pension fund insurance companies, but you can also have foreign investors. So that's good. But the flip side is that these are portfolio investors, and that can go in and out, the so-called hot money. And then that can have some very serious consequences on your exchange rate, for example, if you have a lot of money flowing out suddenly, abruptly. So it has to be looked at carefully, but you have to manage it carefully.
All right. So the region, or Sub-Saharan Africa, is not known for its transparency and its strong legal and regulatory framework, which you say in the article is actually required to make this work. So what does Sub-Saharan Africa need to do? What do these countries need to do to reap the full benefit of this trend?
Yes, I think we should start, we say IMF, it's mostly fiscal and so on, but we should go back with a very important precondition. Having stable macro conditions is really something that will help you develop your market. If you have the strategy of developing your local domestic debt market, it has to be part of a bigger, basically more comprehensive strategy, starting with having a stable macroeconomic conditions. So, for example, if you are not able to control your inflation or reduce your inflation, your rates, your nominal rates will be very, very high, and your environment will be very, very uncertain. And African countries are doing actually a lot of efforts in that direction through macro reforms. If you are able, for example, to get a lower inflation, a stable inflation, that definitely will help your bond market because investors and anchoring inflation expectations, right? So that's one, because your nominal rates will be lower if you reduce inflation. That's one. And then, of course, the investors want to be repaid. So then we are back to your debt sustainability and so on. And if you're on a path, right, where your debt is sustainable, that's going to help you. Then you also have debt transparency. You have also your debt manager who should be able to see what will help you, what type of market will help you have a lower cost and so on. So I think monetary policy, fiscal policy, we back to the fundamentals of what the IMF is doing and so on. I think, but you have stable macroeconomic conditions, then you can start, especially like the cornerstone of a bond market is the money market, the very, very short end, right? And then you can start building from the money market and increasing your maturity and so on. Then another one is also, if most of your debt is going to banks, you want to protect depositors too, so smart regulation. So there are all these things to be done, but we are often back to stable macroeconomic conditions, and then you can start building up on this strength.
So it's great. It's always good to see African countries investing in themselves, and let's hope that the incentives to do so continue to grow. And I love how enthusiastic you are about seeing this happen.
Yes, definitely.
Amadou Sy is an assistant director in the African department here at the IMF. Thank you so much.
Thank you very much for having me.
Look for Amadou Sy's article on the new face of African debt in the March issue of Finance and Development magazine. Go to imf.org/FND. And look for other IMF podcasts wherever you listen. You can also follow us on X. Our handle is @IMF_podcast. I'm Bruce Edwards. Thanks for listening.